Get that done. Okay, and then I'm gonna share, oops. This is the end of a very long day for me, so guys, bear with me. So to get started, thank you guys all for being here with the Portland Elder Care Council. For those of you who don't know, we are an alliance of volunteers, female volunteers at this dedicated to helping our community plan for issues as they get older. So we want to help older ones, their caregivers, their family with free education and resources so they have clear solutions to difficult problems that they face in planning. So we'll do a little intro of everybody. First, our board is myself. I'm the president. We need to update the name. I specialize in senior placement. Kelsey is our realtor, specializing in with seniors, and Jamie Levin is our Madame Treasurer, and she's a social engagement specialist. We also have Whitney, it's a right sizing coach. Mariah is our money guru. Melissa is a aging life care manager, and Suzanne is a guardian and fiduciary service. We also have Nora King, who is a Medicare plan specialist, and Jennifer Trendy with elder law. And our newest member is Sarah Nelson, and she's an in-home care specialist. So that's our little group. And we have these webinars every other month. And this month we have a guest speaker. Michelle's not a member of Portland Elder Care Council, but we reached out to her as a reverse mortgage specialist to see if she would educate us and the population that we're trying to help so that we can understand reverse mortgages better. So I'm going to turn it over to her. She's got some slides for us, and she wants an interactive group. So if you've got questions, shout them out or pop them in the chat. She wants us to be involved. So go ahead, Michelle, take it away.
Okay, yes, please feel free to step in at any time. I'm Michelle Zafiris. I'm with Fairway Mortgage. I'm a certified senior advisor, and I specialize in reverse mortgages. Let's see if I can get.
Looks good.
Can you guys see my screen?
Yeah.
Okay. All right. So before we start, I just kind of want to get out of the way, like, what is a reverse mortgage? And then we'll talk about, and then we'll, get past the details and get on to the fun stuff. And you probably didn't think of reverse mortgages as fun. But I am a problem solver, and I like to help people solve their problems. And particularly with money, and money can't buy you love or happiness, but it sure can help out. It can buy you some peace of mind, and it can buy you some things to make your life a little bit better. So the reverse mortgage is a loan. So let's just really quickly talk about what type of loan it is. It's a loan that's available to seniors age 62 and older, from all levels, any income. It's an FHA insured loan. So it is insured by the federal government, and there's certain qualifications for FHA loans. And it has to be your primary residence. It has to be a home that you live in at least 6 months out of the year, and what you call home. This is a loan. It's like any other mortgage loan. So you keep the title to your home. When you sell your home, you pay the loan off. Money that's left over goes to you and your heirs, just like it would any other mortgage. It has some basic income qualifications. One of the things we run into with seniors is once they stop working, they have to rely on savings. So a lot of times they cannot qualify for traditional mortgages. And it's very hard for them to get financing. So this is a special program where the income and the credit standards are a little bit lower, and we evaluate them in different ways. And essentially what the reverse mortgage loan does is it allows you to convert about half of the value of your home into cash. So if you have a $600,000 home, you can convert 300,000 of that to cash. And you don't have to pay that back for as long as you live in the home. And it is a federally insured product. So if your loan balance or you owe more on the home than it's worth, you have insurance to cover that. So it's unlike any other loan product where the debt follows you. In this particular product, the debt follows the property. So the property is responsible for paying the debt, not you. So that can never come back on you or your heirs. And that's how we're able to have lower qualifications in income, because we're not trying to see if you can pay back a debt. We just want to make sure you can take care of the property. And so that essentially in a nutshell is a reverse mortgage. You don't, once you pass away or you sell the house, then you pay off the loan like you would any other mortgage. And you can also use this loan to purchase a home. So those are kind of the basics of a reverse mortgage. And so have any of you had any experience with reverse mortgages, or do you have any particular questions about reverse mortgages that you'd like me to cover? Have you heard some scary, awful things that you want me to address?
Yeah, I heard if you've got a husband and wife on a mortgage, the husband can borrow against the house on a reverse mortgage without the wife's knowledge. Is that possible? I mean, I've heard that happening, and then the husband dies and all of a sudden the wife realizes there's this mortgage on the house. Have you ever heard of that?
There was a time when you could do that. You can no longer do that. If you are married or in any type of domestic partnership relationship, both people must be on that loan. Both people must go through independent third-party counseling. So those are some of the safety precautions that we've had. Back in the day, you used to be able to, and I'll talk about that a little bit too, but you used to be able to exclude a spouse. We saw that happen a lot when one spouse was 62, but the other wasn't. And so they say, well, we'll just leave that person off the loan. Or let's say that one spouse was, older. The older you are, the more money you have access to. So they would say, well, let's leave the younger spouse off the loan so we get more money. And then time would pass and the older spouse would pass away, and then the loan becomes due. And so the poor surviving spouse would be stuck with a house that had to be sold and had to be liquidated. So HUD decided to come in, and they were not in the business of foreclosing on widows. And so they changed those rules and those regulations. So now, whatever age your spouse is, they are required to be on the loan balance. Now,
and you mentioned domestic partners. What if there's a domestic partner situation, but it's only one of them that owns the house? Is it just the people who own the home has control over that?
Yes, you have to be the homeowners. So you
Okay.
So that only pertains to married couples if they're under the age of 62. So if you have two people that own a house and they're both over the age of 62, they can get the loan together. We have families, where you may have 3 siblings and they all live together in their old age until they pass away. There's no, marital requirement or anything like that. If you're over 62 and you own this house, you qualify for the loan. The exception is if you are married and that person is under the age of 62 and technically doesn't qualify. That's when they also, that's the exception that we put them on there. So now, there's, like with any marriage, right? There's a risk that, one spouse could drain the joint bank account before someone found out about it. But, you do have, there is processes that you have to go through to access your cash and things like that. but he just put a reverse mortgage on it and not tell the wife. That would never happen. They would have to be on, and they would both have to go through counseling. So they would have to, HUD has an independent third-party counselors, and they have to go through that counseling session. And it depends, that it can be anywhere from 45 minutes to 2 hours. It can be a second session. It's whenever that counselor feels that you understand what this loan is, and you've gone over your finances, and there's a reason for obtaining it. So there's a demonstrated need. They understand why they're getting it and what they intend to use it for.
Okay. So as long as one of the people owns the house, as long as one of them is over 62, they could get the reverse mortgage, and all of the signers would have to agree, and then it's available to all of them?
Yes. Oh,
Wow.
yes, the spouse, and the only one that can be under 62 is the spouse.
Okay, so in your example of 3 sisters living together,
Mhm.
they all have to be over 62.
Yes.
Okay.
Mhm.
Okay.
So I have a quote up here from Wade Pfau. Use strategically a reverse mortgage can greatly improve the sustainability of your retirement income. And Wade Pfau is a retirement researcher from the American College of Financial Planning. And we kind of have him to, he really shifted how we look at the reverse mortgage and how we use the reverse mortgage. Even though the reverse mortgage came out in like 1986, and it's been around and used and misused and poorly understood. And so, you know, in the early 2010s, he took a look at it and he said, well, what is this last resort loan? You know, why is it for poor people? And he did extensive research on it. And what his research really showed us was that using it as a last resort or at the last moment was the worst possible thing that you could do. And that in fact, if you used it early on, you could avoid a lot of the situations that would put you in that last resort type of situation. So, you know, I had a client about 6 months ago, and husband and wife, and they were going to, they needed to get the reverse mortgage in place. And they were kind of hesitant because they knew there were going to be some changes to the loan product where they thought they might get more money out of it. So they thought about waiting. And you never know. I thought it was a little bit risky to do, but it's what they wanted to do. And the husband said to me, well, you know about my health, right? I said, well, no. He said, oh, I just got this cancer diagnosis. And I said, okay. And so, that led into a conversation of, okay, well, what happens next? You're in a type of situation where your particular type of cancer, you could be gone in a few months, or you could be gone in a few years. Can you afford to wait? Because they had a high mortgage payment that needed to be made. I said, if you get sick and you can't work, we may not be able to qualify you for the loan. And if you were to pass away, what would happen to your wife? There'd be no way on her reduced income. She would lose your income from work. She would have a reduction in her Social Security income. There's no way she would be able to eliminate her debts. And so they immediately went ahead and moved forward to the loan and put that in place for protection of the wife. And so there's a lot of examples like that where getting that mortgage early on can be really valuable. So the other reason that not only the financial planning community has taken a huge interest in it, but was due to Wade Pfau's work, was how do we use this as an asset or as a tool? And so he coined what we call kind of like a buffer asset. whereas is that you should be treating your house as you would any other asset, like your income or your Social Security or your 401k plans, and utilize all those assets most efficiently. The government also knew, and that's why they've improved regulation of this product, that with baby boomers, we were going to have 10,000 people a day turning 65. We were living much longer. People were not ready for retirement for a variety of reasons. It's not unusual for me to see someone come in that has a small pension and a small 401k, but not enough for either. With the financial crisis in 2007, we saw a lot of people approaching retirement, unemployed for time periods. They drew on their retirement plans early. They have, harvested equity out of their homes for use. And so they're arriving in retirement with less money, and more debt. A lot of time, most of the time that's mortgage debt. It can be credit card debt. We've seen student loan debt. And so that's why we kind of need to utilize. And so they arrive in retirement and their single greatest asset is their home. And it's an illiquid asset and they can't do anything with it without the reverse mortgage. So, when we look at using a reverse mortgage, this slide represents the accumulation phase of our retirement planning. And this is when we're working and we have a job and we have income coming in and we're using that for our daily expenses. And we're also hopefully putting some away into our savings account. But a lot of us are putting, anywhere from 20 to 50% of our money into our home. So throughout our lifetimes, we're putting a significant investment into this asset. And so when we get to retirement or we get to the decumulation phase, that job stops and that income simply stops coming in. And it's a very difficult time for retirees because all of a sudden they have a whole lot less income and they're very aware that, oh my gosh, this is all I have and it has to last me the rest of my life. And so that's when home equity comes into play. And so when I'm working with someone, I look at their income, Social Security, pensions, and their savings, whether that's 401ks or investments or real estate. And we also look at what they have available in home equity. Let's see, I'm going to. So probably one of the biggest benefits to the reverse mortgage is being able to access money that you don't have to pay back, eliminating that monthly mortgage payment. And a lot of people say to me, oh, well, Michelle, I can afford it. Well, yeah, you can afford it, but does it make sense to afford it? It's not uncommon I have people, they're 67 years old, they know they're going to retire soon. So they go into their local bank or their mortgage broker and they say, oh, I got to refinance my house. I got to get the lowest rate I possibly can. And then they go in there and they commit themselves to this huge debt obligation for the next 30 years. And they'll be making these huge payments. They'll be taking cash and liquid assets and things that they need to survive on a daily basis and putting it into an illiquid asset until they're 97 years old. And while they can't afford it, they stop working, someone has an illness, someone gets an ALS diagnosis, or you all run across this every day. And then it's like, what do we do now? So eliminating that monthly mortgage payment as early as possible is really important. And you do qualify for this loan at 62. So we really encourage people to take a look at it then. You can still make payments on your mortgage. You can still pay down your mortgage payment, but you don't have to. So if you get into a situation, you're in a situation where you can put yourself essentially into forbearance at any time. So we saw a lot of people during COVID go into forbearance and not have to make their mortgage payments. and then worry about, how to pay that once they had to start making payments again. This essentially puts you in permanent forbearance, so they never really have to make that payment, but they certainly can. And it also, if a lot of people have, $1,100, $1,200, $2,000, $2,500 a month mortgage payment, that's a lot of money that could be used elsewhere. It could be used to put into savings, to purchase some type of life insurance or long-term care policy, or other areas. So there's three basic ways that we distribute funds from a reverse mortgage. One is a lump sum. So if your house is worth 600,000, and I'm using about 50% for educational purposes. It can vary a little bit. It can be a little bit below that. It can be a little bit above. But for the purpose of this, I'm just going to say 50%. And so if you have a $600,000 home and you have access to 300,000, you can get that in a lump sum with conditions. So we usually use all of that when you purchase a home, and you can use a reverse mortgage to purchase a home. And a lot of seniors aren't really aware of that. When they're in a family home, they've raised their children in, it's maybe not suitable for them anymore, or maybe they need something smaller, or maybe they need to be closer to family, but they don't. The notion or idea that they can move is really hard for them, because yes, I can sell my house for this money, but then I have to buy something somewhere else. And so the really nice thing about the reverse mortgage is that you can buy a house with putting half down. So on a $600,000 house, you can put down 300,000, and we reverse mortgage the rest, and you can live there without having to make a payment. And this is one of my favorite ways of using the reverse mortgage. It's actually how I got involved. My mother had wanted me to look into it, and I thought it was a terrible idea. And I did a lot of research, and I read Wade Pfau's book on it, and learned that it actually was quite a good idea. And so she was in a situation where she was out in a suburban house. It was 2-story, stairs, no bedroom or bath on the main level. There was just a half bath. I was afraid that she was getting very isolated. She had enough income. She didn't really necessarily need the reverse mortgage. But with that purchase option for her, I was able to sell her home, pay off her existing mortgage. So that gave her an extra $1,100 a month to spend. Use the proceeds to purchase a beautiful home, beautiful townhome in a 55+ active community on a golf course. And then she had money left over to put in the bank. And this is a huge, huge issue for retirees, because it can be a significant windfall for them. Because a lot of retirees, they don't want to have that mortgage payment in retirement, and so they pay cash for a home. In this instance, you can pay cash for half that home and use the cash for other means. So it can be very, very significant if you have a $500,000 investment portfolio, and suddenly you add $300,000 to that. That is a huge, that greatly extends the lifetime of your investments and your income throughout retirement. And so it not only was a great move for her financially, personally, it was such a great move for her also. And she, but I want to leave the house to my kids, and I want to leave the house for you kids. I want to be able to leave something. It's like, well, you're still going to leave something. You're going to have less equity. You're not going to leave as much from the house, but you have more money to spend now. And she does. She can spoil her grandkids and she can spend money on them now, as opposed to waiting until she dies. And she does spend that money. So The other way we use refinance is when we pay off a large mortgage payment, which is huge, getting rid of that huge debt obligation that time in life. If you're taking a lot of money out of your savings and investment early on in retirement, it's going to significantly decrease the lifespan of your retirement savings. Probably for those of you involved in senior care and working with seniors, probably the most important piece of the reverse mortgage is the line of credit. And it warrants a little bit more conversation, because it's you can put your funds into a line of credit and you can access them at any time in many different ways. And so that's an important critical piece for a lot of people. Will use that for their in-home care, for long-term care, for, if someone is injured, has an illness. And we use that a lot to protect the surviving spouse. When we have one spouse that becomes ill and maybe has to go into a care facility, that line of credit becomes really, really, really critical for that surviving spouse. And I kind of like to show you how the line of credit works. If we have that $600,000 house, this is a little bit less than 50%, but the green line shows you, kind of your home value over time. The line of credit that's established, it is guaranteed, the unused portion of that is guaranteed to grow over time. So you could have a scenario where your access to funds is even greater or exceeds the home's value, and that's why it's insured. But you have this line of credit, the unused portion of which that grows over time, and it's guaranteed and it can never be taken away. And so that's the really critical piece when we get into care for seniors. Those funds can be used for in-home care. Where we really see it a lot is when we have one spouse that has to go into a care facility, and we still have that surviving spouse that's healthy and doesn't necessarily, need or want to live in a memory care type of situation. And it's a way to protect them and give them access to funds without, completely bankrupting them. So I had a couple where she had a Alzheimer's diagnosis, and he was still able to take care of her at home, but he was pretty healthy. So with him, we were able to set up this line of credit for him that he could draw on, and we took some funds out so he could buy himself a car and take her places. And now she is in a care facility, and he's still at home, and he has those funds to draw from. She's actually, and that's where we also get into the spend down and the Medicaid. And so that's where working with attorneys is really critical for that spend down piece. But this providing liquidity is a huge piece of that. Do I have any questions?
I don't see anything in the chat. Oh, Whitney's got her hand up. Go ahead.
Oh, Michelle, how do property taxes work with a reverse mortgage? Who pays those?
So you are still, like any other mortgage, you're still responsible for your property taxes, insurance, and maintenance like you would any loan. If you don't pay those, you can get in trouble like you would in any type of situation. We can set up what we call a LISA, a life expectancy set-aside account, and use the proceeds of your loan to pay your property taxes for you. Most people choose not to do that if they don't have to, because they want to preserve the funds in the line of credit. So if they need to use those funds, for property taxes, they'll take it out of the line of credit themselves. but we can also put that aside. If someone has, income instability or difficulty making payments, sometimes they'll require, Elisa, a set aside for your property taxes to be paid. And so let me see.
I have a quick question. Can
Uh-huh.
you defer your property taxes if you have a reverse mortgage?
No, you cannot. You can do one or the other. So you can either be part of the property tax deferral, or you can do the reverse mortgage, one or the other. So if you're, I had a woman who was in the property tax deferral program. And so what we did is we came in and the reverse mortgage paid off her mortgage. It had to pay off that property tax debt. So all those liens were satisfied. Any lien that's attached to the house has to be refinanced and paid off from your proceeds from the reverse mortgage. And then we put, I think she even had enough where we were able to do a set aside for her as well. And then she also had a small line of credit. So she could use it. She had to have the water heater replaced and things like that. So, and Oregon has gotten, they've taken, I think they had 2 programs and now they have, they eliminated one. You definitely don't want to run afoul of property tax payments. I've had to fight with especially Multnomah County, trying to get houses back from them once they've gone through that process.
That's happening
What?
with one of my clients right now, Michelle, where they had a reverse mortgage, but the gentleman developed dementia and wasn't paying the property taxes, and the family didn't really know what was going on. And
Oh no.
yeah, it's not good.
How have they started the foreclosure process on him, or how far?
Yeah, it's going to foreclose by the end of this month. So we're coming in and clearing out the house before the end of the month.
Oh, wow.
Yeah.
Was he not able to get proceeds from his reverse to pay those, or?
I think it's a really old school reverse mortgage. There seemed to be no funds left, and the wife didn't really know what was going on with finances, and she's now been moved to assisted living. So it seems like kind of a messy situation. There's probably more there than I realized or that I know.
Yeah,
But there are no funds left.
I know, it's really difficult. They used to, because they know people need to use this program and it needs to be safe and secure for the duration, they've really tightened up the amount of funds that you can get out. But if you have some of those old school mortgages, reverse mortgages, they used to give you a lot of money that they don't give you now. And so, I do get calls from Adult Protective Services, and those are always so difficult because they do it. Yes, the reverse mortgage did its job. This gentleman got to live in his home for 15 years that he otherwise wouldn't be able to do. But then he has a stroke and he needs services, and he needs to sell the house because he's behind on property taxes before the county comes in and takes it. And it's a really difficult situation. And this one in particular gentleman I was thinking of was in the Selwood area. So he had a significant appreciation in his home. He still had a few $100,000s of equity in his home. I couldn't get any more money from the reverse mortgage, but he still had 300,000 or more in equity in the home, and he was disabled and living in a 2-story home with a basement with a ton of deferred maintenance on a double lot, and I said, just sell your house. You have this money. You could buy something else. You could put it, we could put it into a fund that would help provide for your care. You could be somewhere closer to the services that you need, and if there's no family to intervene and kind of push the issue, it's difficult. But if you ever have situations like that, it doesn't matter if it's my loan or an old loan, call me. Or if there's a problem with servicing, call me. I'm happy to look into it. So,
That's nice, Michelle. There's a question in the chat, and then I have a question, but I'll do the one in the chat first. Jamie asked if the rates on reverse mortgages are different than conventional mortgage rate.
yeah, so you can get a reverse mortgage on a fixed or an adjustable rate. Almost always people choose the adjustable rate as it's significantly below market. So right now, you know, traditional mortgages are around 4%. The reverses are in the low 2s right now. The difference, and this is one of the most counterintuitive pieces of the reverse mortgage. And one of the ones that I had a really, really, really hard time wrapping my head around, because I'd spent my life trying to pay the least amount of interest I possibly could and to fix in the lowest rate I could for as long as I could. But the main difference between the fixed and the adjustable rate, on a fixed rate product, your interest rate's going to be higher. And it's a one-time deal. So you're going to get a little, because the interest rate is higher, you're going to get less money out of your home. And so it's a one-time deal. It's paid in a lump sum and you're done. It just sits there. And then when you sell, it gets paid back. Whereas if you're on an adjustable, and then that's where you have all the flexibility in the program. So you can, you know, pay off that mortgage. You can develop that line of credit. You can take money out of the line of credit. You can put money back in. There's all kinds of things that people do with it. They'll let their, you know, they'll let their interest build up and then they'll pay it off and take the tax deduction. And then they'll let it build up and pay it off and take the tax deduction. And that line of credit grows over time. So if you get a line of credit of $300,000, that's growing by whatever your interest rate is every month. So whatever the interest rate is you're paying on the loan, that line of credit is growing by the same amount. And so that's why we see that line go up over time if you're not using that line of credit. And so people you can do lots of creative things, but a lot of people just let that line of credit grow. And then, when one spouse passes away, then those funds come in to replace the ones that were lost with that spouse, or to provide that long-term care, or, whatever those other needs are. And so, because the interest rates are so much lower, it ends up, and there's so much more flexibility within the program, that it ends up being financially almost always better off. I've done 2 loans that were fixed rate. One was my mother's, and one was for a real estate agent who is insistent on having the fixed rate loan. And I ended up refinancing my mother into an adjustable, because it was just a much better deal for her. It lowered the amount of interest that she was paying. It established a line of credit for her. So now she has that sort of emergency fund that she can draw on when she needs. So she knows now that if she gets an assessment on her townhome, or there's work that needs to be done, that there's a fund there to pay for that. The other woman, she really did she needed more money. And I couldn't do it because the interest rate was higher, and she didn't have enough equity in her home. And so that one's actually kind of haunted me for a few years. I think about her all the time, and I always kind of go back every few months and I look to see, has her home and appreciated enough in value where we could do it. So, and then the ones that are unadjustable are capped. So right now, if your interest rate is, say, 2.5% on an adjustable, I always sell a cap 5. So that means that it can never go over 2.5 plus 5 or 7.5%. You can get a little bit lower rate if you want to do a cap 10. That would allow that interest rate to go up to 12.5%. I typically don't recommend doing that. And, people, well, what if it goes up to, 7.5%? Isn't that bad? Well, that line of credit is also increasing by 7.5%. So you're also gaining funds. So it both giveth and taketh. Does that?
Yeah, and then somebody else just asked, Jody asked, with the adjustable rate, can it jump higher than the conventional rate loan or mortgage rate?
Well, a fixed, meaning over the lifetime of the loan, Jody, or?
So I just want to make sure that I'm thinking of this in the right way.
Okay,
So if someone does the adjustable, which you said it's in the low twos. And so I probably used the wrong word. The fixed is in the 4.
yeah.
So
yeah.
adjustable meaning it's going to adjust with the market. Is that what you're saying? And could it go, like, say, fixed is still 4%, but because it's an adjustable, could it go to 5, 6, 7? And
So
fixed
yes,
is the 4?
it's possible that, let's say 8, 10 years down the line, interest rates rise and you're paying 5%. And 10 years ago, you secured a fixed rate at 4%. You would, you could be paying, you wouldn't be paying higher than the market. So the industry uses treasury bills, so plus the margin. So your adjustable is always going to be lower than a fixed.
Yes.
Always. But it is possible because, your interest rate started at 2.5% and it has the potential to rise as high as 7.5%. That if you had locked in one at 4 or 5%, that one could be lower. However, what I found the hard way is that, the higher interest rate, they're paying a lot more interest. So like in my mom's case, she went from paying almost 5% in interest down to 2%. So she was paying so she was adding a lot less interest and a lot less debt to that loan by shifting her from the fixed to the adjustable. I had one gentleman who owns is a broker, a mortgage broker, and he never converted to a fixed rate loan. I think until just recently he did it. He always kept it as an adjustable, and he did save a lot more money on interest than people who had done the fixed, which is hard to wrap your head around if you lived during the 80s and there was, of high interest rates. People all remember that,
One more question that's in the chat that Nora had was, if someone has a reverse mortgage and needs to go into assisted living, does the mortgage automatically terminate?
Yeah, so once you've been in the home, once you have been out of the home for medical reasons for 12 months, then you need to sell the home or pay off the debt. Once it's established that they're assisted living, it's more than a year, it's up to a year, and they're not coming home, that's when the family needs to come in and make other arrangements. Now, if there's a spouse, that spouse can stay there for the rest of their life. But about a year. So if they have a stroke and they have to be in a facility for, a few months, and then it looks like they're going to be able to go back home, they're fine. It's just when we get on to a year, it's 6 months for non-medical reasons, a year for medical reasons, that's when, and HUD will, they'll send you a note once a year, saying, are you still living in the home? And they try and do their best. One of the unfortunate parts of the loan is that as soon as that person, dies, or they're permanently out of the house, or whatever that may be, immediately the foreclosure notices start coming, and it's just the rules. But it's very difficult for the people that the relatives or friends or people that are trying to help that person, because they're getting, these notices. But, from the time that that person is, out of the house and you have to do something, you have up to 12 months to do something. So there's a pretty extended runway. So there's 12 months for that person to, be out of the house, and we know this person is going to be out of the house. Okay, then you notify the lender. And then you have, 6 to 12 months to figure out how you're going to sell it or refinance it, or what it is you're going to do with it. The biggest thing is keeping in contact with them. So when you fill out your application and when you sign your loan documents, they do have you put alternative contact information, because, we hear all these horror stories, oh, these foreclosures. Well, what happens is, someone gets sick, they end up going into a facility. The relatives don't necessarily know what their financial status is. They go onto the facility, they don't think there's any money in the home anyway. And then there's a vacant home, and it just eventually, gets foreclosed on because nobody does anything with it. But
It's helpful to know that there's that time frame, though, that, for if one of us or as senior professional is involved to advise the family what steps to take and what the time frame is that they have to work in a situation like that.
yeah.
I don't know if you have any more slides to share. We usually wrap up right around this time, but if you have anything else you need to show us on your.
No, I don't have anything. I don't have anything to show you. I wanted to more address things that were specific to the issues that you would be dealing with and working with seniors and needing care.
Yeah. My question too was, for those old school reverse mortgages, if somebody, is there a way to clean them up at all nowadays so that the owners of those mortgages are not in a bad position? Can a new mortgage specialist look at it? And
oh yeah, we can always look at it. The challenge is right now we say, oh, it's around 50%, maybe a little bit less in cash that they give you. Those older mortgages, they were 60, 70, 80. I mean, they gave you a lot more cash back then. And so a lot of times they just don't have enough equity. But in Portland, we've seen such a dramatic rise in prices that, yeah, there are some times when we can do that. So,
especially if we have somebody that we feel might be in a not the best situation with their reverse mortgage. So,
yeah.
Well, great. If you don't have anything else, any other slides, and if anybody has any other questions, I mean, we do have Michelle's contact information. So if anybody wants to, yeah, we have it there. I can make sure to share it with whoever needs to contact her. I think it's super beneficial for us to know that if we have any issues, we can reach out to you to take a look at things and kind of help us point our clients in the right direction.
Yes, like I said, it doesn't, anytime you have a question, you can text, email, call, because they're complicated, and it's really hard when all of a sudden you're cruising along and someone gets a diagnosis and they're in a facility, and what is this, right? I mean,
yeah,
absolutely. And you can, people, 90% of people want to age in place, and they can do that. So
yeah, absolutely.
it's money to, remodel, or to, bring in home care, modify the home.
Jody's got her hand up.
Yeah.
Too.
Are you saying goodbye?
I will say hello again. You bet, Beth. I just want to say that Michelle and I, we met, I can say last year now. And I just adore her professionally, personally, and I have all the faith and trust in the world. with
Oh, thank
her
you, Jody.
advice, mentoring, or if she was to work with one of our clients. So I just wanted to give that shout out to you, Michelle. You
Oh,
rock.
thank you, Jody. I appreciate that.
I
Thanks,
appreciate
Jody.
you.
That's super helpful. I liked hearing that. Well, thank you so much, Michelle, for being here with us. And we've got, she has a really great article that we're going to have in our newsletter this month too. And then this will be recorded. So if anybody wants a copy of the recording for reference, you're welcome to email me and I can share that with you. I'll actually stop it now.